We are just about ready to finish up with topic 8, which is on depreciation. There's one more little piece of it that I want to introduce you to today, and then you'll have a problem with this tomorrow. So let's look at the screen. You see a general journal for the ABC company, and you see a number of things already put into the journal, and also they would have been, actually were, posted to the ledger. So we're not going to walk through every one of these because these are very common transactions. You see on February 1st, we bought some equipment for cash, $7,500. One note over here that we need to pay attention to later in this problem will be the information given to you along with the purchase of the office equipment. The office equipment will have a useful life of 10 years, no salvage value, so it would decrease in value by 750. 7,500 divided by 10, 750 a year, and this company has a accounting period of 1 month. That's important. So then we need to take the 750 divided by 12, and the depreciation on the office equipment is $62.50 a month. We'll come to that a little bit later. But the transaction is very simple and is posted to these two accounts. We bought some inventory for cash, again posted to these two accounts. Again, more inventory on the 12th of February, again posted to those two accounts again. On the 18th, more inventory purchased, $12,060. This time we charged it, so we owe money. So the liability account, accounts payable, is credited. And then we made some sales, and if you look over here on the right, it tells you that we made sales on accounts, 200 units at $150 a piece, totaling $30,000. And we use that information just a bit later. So the transaction is recorded into the journal, accounts receivable debited, and sales credited. Then we're at the end of the month. So far we have 3 different kinds of transactions that are important for this company because they pay their employees on a monthly basis. So this salaries expense transaction is done at the end of the month. So they earned, as you will see over on the right, employees earned a total of $15,000 this month. So the salaries expenses debited. Then we have our liability accounts that we talked about in topic 6. Income tax, federal and state, FICA tax payable. These are amounts of money that we withheld from the employees' paychecks. And they become a liability to us because we have to pay it on behalf of the employees. Then cash is credited by $13,200. This is the net pay or the take-home pay for the employees. So that transaction is not new. Neither is the next one. This is the cost of goods sold. And as it says over here on the right, we recorded the cost of goods sold entry. And this company uses LIFO, and the arithmetic is done for you down here. We refer back and see that we sold 200 items. So if we look at last in, first out, this is the arithmetic needed, and you should understand how that works by this time. So when we do that, we figure out that the cost of the goods that we sold, those 200 items, cost us $13,360. And that's this entry, cost of goods sold expense and inventory credited. That reduces inventory by that much. And finally, the last entry, depreciation. This is from this topic, topic 8. We looked above and saw that the depreciation for this computer or the computer system is going to be $62.50 every month. So this entry has to be made at the end of every month. Depreciation expense is debited. Accumulated depreciation for computers is credited by $62.50. So those are transactions that you ought to understand by this time, and they are all put into the ledger. You see cash had a beginning balance, and these are from the entries we just looked at, leaving a debit balance of $50,030. Accounts receivable, we have customers that owe us money, not only from this month, that $30,000 that they charged, but from previous months as well. Inventory, we bought inventory 3 different times, and then we figure the cost of the goods that we sold, and leaving us with a debit balance in inventory, $17,700. We have some supplies. We didn't buy any more. We didn't get rid of any. So we still have a debit balance of $876. And then we have the computers we bought for $7,500. And then the contra account, which means an opposite balance of $6,250 that we just saw in the journal. So those are the assets. Liabilities, same way. We had we owe some money from last month, $1,810, and we charged some other things this month. So we owe a total of $13,870. Apparently we have a loan, but we didn't do anything with that this month. We still owe that amount of money, $32,000. And then the payroll tax liabilities. The $900 for federal in January and another $900 that we just journalized and posted in February represents 2 months. And if you remember, we pay this once a quarter. So we don't do anything with it right now. We have a balance that we owe of $1,800. In March, we will have another entry and another $900 and a new balance of $2,700. That's when we pay it, at the end of the quarter, at the end of 3 months. Same way with the state, same way with the FICA tax payable. Owner's equity, we're not going to do anything with right now, other than I want to point out this new account that we will be looking at in topic 9, and we're not going to be concerned with that at this point, but we will in the next topic. Revenue, we had one sale, $30,000, we have accredited, and then the expenses, depreciation expense for computers, and salary expense, and we have cost of goods sold expense that we just figured out. So those are all the journalizing and all the posting that has been done for this company. Now, the next step that's new is to simply take that information from the ledger and put it over here into the two financial statements of the business. So we learned early in the course, back in semester 1, a little bit about the income statement and the balance sheet. And what we simply do is go back to the ledger and plug in the amounts. So for the income statement, we need revenue, which is sales. We just go to the revenue part, look at sales. The balance is $30,000, and so that's what we plugged in. Same way with the expenses. We go to the expenses in the ledger, and we look at those 3 accounts that we have debit balances, and we simply put those amounts of money into our income statement. This $28,422.50 is simply the total of these 3. And when we subtract total expenses from the revenue, we get a net income for the month. Same thing happens with the balance sheet. We look at the final balance, not the beginning balance. So for cash, we go back to the cash account. We look at the bottom number, not the top, not the beginning, none of these numbers, but we look at, that's inventory. We look at the bottom number for cash. So we started with $89,730, but the final balance at the end of February is $50,030, and that's what goes into our balance sheet. Same way with accounts receivable. We go back to that account, plug in the number at the bottom, the bottom balance, which is going to include not only what we have receivable at the beginning, this is an amount that people owed us from last month, but also the new amount that was charged this month. So people owe us $37,129. That's what we plug in. We look at the inventory. This is the new balance that we just looked at a bit ago. And supplies we still put in there, even though we haven't done anything with it. It still is an amount of money that we own. We own those supplies, so we put that in the balance sheet. And then the office equipment, the computers, again, back in the assets. Computers we bought for $7,500, we put that in, and also the contra account, which means opposite balance, $6,250. We show that also on the balance sheet. You see the $6,250 in parentheses, that means a negative number. And we have, again, a total asset resulting from adding all those numbers up. Liabilities, the same way. We go to the liability accounts, plug in the balances for those accounts that we see. These 3 payroll accounts then are shown on the balance sheet, and these are the ending balances. These are the amounts of money that we owe. Again, this was money that we withheld from the employees' paychecks, and we owe it for them, but not until March. And finally, this total 49,470 is simply the total of all the liabilities. And pay attention to the note down below. At this point, this is how we figure owner's equity. In other words, the value of the business. We find this amount by using the accounting equation. In this case, total assets, 113,172.50 minus total liabilities, 49,470, and you will get 63,702.50. That's the owner's equity. And when you add those two numbers, total liabilities and owner's equity, you get this amount, which balances the balance sheet. Now, one point I want to make, and I make this here because this is what we will be looking at in topic 9, the very last thing we have to do. All of our income statements and our balance sheet, hopefully all these numbers are correct at this point, but to verify it, we have to double check on owner's equity. We found it by using the accounting equation, but the problem we have with our books, if we go back to owner's equity account, this is not the same as we have on the balance sheet. So we have to find a way to bring our books into balance along with our financial statements. That's what topic 9 will be all about. So we're not going to get into that at this point, but all of the rest of this video will be important. As I said, we're going to have a problem like this tomorrow. So rewind this if you need to, go back and review it again if you need to. Be sure that you understand particularly the last 3 transactions from topic 6 and 7 and 8. At this point, there'll be a few questions for you to answer, so let's do that now.